Hey, good morning once again, options traders. Well, you've heard me talk many times about crossover points, and they're an important concept for traders to understand. They will certainly help you make better decisions about which strikes or expirations to buy. But I thought what would be interesting today is let's talk about why is there always a crossover point? Kind of an intriguing question. Why do we know for a fact we will always have a crossover point if we compare two strategies? So let's go find out the answer. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So for example, let's take a look at a couple of strategies. Let's look at a butterfly spread in red compared to a long $100 call in black. So here's our bend at the 100 strike. In black, that's our 100 call, unlimited gains out this way. Butterfly, we have limited gains and limited losses. But right here where the two lines cross is a crossover point. And it's sometimes called an indifference point. It's where the two strategies produce the identical profits or losses. Now, it's important to understand that this is different from a break-even price. The break-even price is where any individual strategy crosses zero. So for the butterfly spread in red, it would be here and here, where the strategy crosses zero. And for the long call, it would be right there. But that's different from the crossover point. The crossover point is where they produce the same profits and losses. So that's always going to be true for any strategies, and it just doesn't even have to be options. You could compare options to stock, stock to bonds. You will always have a crossover point, at least one. So let's try another example. Here is the butterfly spread compared to a long straddle at 105, and now we've got two crossover points right there. At those stock prices, both strategies produce the same profits, or in this case, the same loss. So the question we want to ask is, why does this always happen? How do we know for a fact that we will always have a crossover point? Well, that's a really good question. So first of all, remember that it's the point where two strategies produce identical profits or losses. Now also, at least for this video, we are assuming that they have the same expiration. It's a little easier to show if we look at the same expirations, but even if we compare different expirations, there will always be a crossover point. And again, remember, it is different from the break-even point. You've got to make sure those are two distinct concepts. So for example, let's say that we have the $100 call trading for 10 and we have the 105 call trading for 7. And if we overlay these, right there is our crossover point at 103. So at 103, both strategies produce the same profit, or in this case, the same loss. So if we paid $7 for the 105 call in red, and the stock is here at 103, it expires worthless, you lose 7. If you buy the $100 call for 10, and the stock is 103, it now has $3 of intrinsic value, so you get $3 back, you spent 10, and you're out 7, exactly like the trader who bought the 105 call. Now, another thing that a crossover point shows, and it's one of the main points about this video, is that it shows that no strategy is better than another. Instead, they're just different. They're different sets of risks and rewards. So if we look at the crossover point, if we look to the left, you can see that the red line sits above the black. And that means that you will outperform the trader who buys the 100 call. Even though you're losing less, it's still considered outperforming. And we can see that because the red line sits above the black. But if we look to the right of the crossover point, now the black line sits above the red. Now the $100 call trader is outperforming the 105 call trader. We can also see that the $100 call trader breaks even sooner. So these are all benefits of the $100 call. Also, if the $100 call buyer exercises the call, he's only going to pay $100 per share. Whereas if the trader exercises the 105, he's going to pay 105. So again, all things being equal, you would rather pay 100 per share instead of 105. And so there's a lot of benefits wrapped up into the $100 call. And that's one way to understand why it has to cost more than the 105. But now let's ask, well, how do we know that this has to happen? How do we know that no matter which strategies we compare, that we will always get at least one crossover point? Well, let's go back to the slide that we saw before, and now let's assume that we have no crossover point. And we're going to do that by switching the strikes. We're going to keep the prices the same, and we're just going to switch them. We're going to assume that the $100 call is trading for 7 and the 105 call is trading for 10. Now, you've heard me talk about in other videos that there's a pricing principle that says lower strike calls have to be more valuable, partly for the reasons that we just looked at. So right now we're assuming something that you're never going to see in a market, and that is that the $100 call is trading for less than the 105. But if that happened, this is the comparison graph that we would get. Now notice something different. The $100 call, there's the bend on the black curve, and the 105 call here in red, we see something different. The $100 call always outperforms the 105. There's never a spot where the $100 call underperforms. So one way to look at this is how we know that this can't exist in the real world. What would you do as a trader? You're deciding between the $100 strike and the 105. Well, you can pay less, you can get to your break-even point sooner, and if you exercise, you're only going to pay 100 instead of 105. What could be better? So traders figure this out. And one way to understand why there has to be a crossover point, let's just look at the buy side. The traders who recognize the $100 call is better than the 105. So as they run out there and buy the $100 call, they bid up the price, and that's going to push this graph lower. Now, new set of traders come in and they say, you know what? The $100 call is still better. It still outperforms the 105, so we have more traders that are buying the 100, and the price continues to rise, which makes it sink lower into the graph. Okay, so now we have the $100 call that's been priced at a higher price, but it's still, relatively speaking, better than the 105. So more traders will continue to buy the 100 instead of the 105. What does that do? Pushes the price up even more, and that makes the graph sink even lower into the chart. Now what happens? Now the 100 and the 105 are priced the same. So again, if you had the choice, well, you might as well take the 100. You do reach the break-even point sooner, and you are going to pay less for the shares if you decide to exercise. So there's still some benefits. You're not paying less than the 105, but there's still some added benefits for which there's not an additional price. So traders will say, okay, let me still reach for the $100 call. They push the price up even more, and what happens? Eventually we have to cross. And there's our crossover point. So the thing to understand, what the crossover point shows, is that the advantage has been priced in. And this is why you have to be very careful if somebody says this strategy is better than another, or this strike is better than another. It's not. It's just different. It's a different set of risks and rewards. It's a different tool. And that's how you have to think to be a better options trader. Now we can reach the same conclusion by just looking at the sell side. This time we looked at all of the traders buying the 100 call. Well, what about, let's go back to the beginning here, with traders who are sellers? Maybe people who are using a covered call. Well, now they'll realize, hey, if you're going to sell a call, you might as well get more money for it, have a higher break even. We'd much rather sell the 105 call over the 100 call, and I'm going to get more money for it. What could be better? What's that going to do? It's going to set off a chain reaction where everybody is selling the 105 call, and the red line will now continue to move up until we get a crossover point. So now you're probably seeing, well, why not do both? And that's exactly right. What's going to happen if we saw this pricing, the $100 call at 7 and the 105 call at 10? Traders would simply buy the 100-105 vertical spread. They're going to buy the relatively cheap one and simultaneously sell the relatively expensive one. In this case would be for a net credit of 3. But notice that the 100-105 vertical should be a debit spread. But we're getting paid to take something that could grow in value. And so this is the resulting risk graph. Notice we have no point where we can lose. There's no reason to not take this trade. You're guaranteed to make 3, but if the stock continues to climb, you could make a total of 8. And that's because you have the right to pay 100, the obligation to sell for 105, that's 5 points in your pocket, plus the $3 you got up front. So why not do it? There's no reason to take this. This is called an arbitrage. And what it's going to do is to put buying pressure on the 100 and selling pressure on the 105. And so those two lines are going to cross really, really fast. Now we could also reach the same conclusion by going in the other direction. What if the 105 call were too cheap? Now we do know that the $100 call should be more valuable than the 105, but the question is, how much more? Is there a limit on how much higher it should be? Well, as we said, the $100 call provides a $5 benefit over the 105 call. So therefore, it can't be more than $5 more. Anytime prior to expiration, you'll probably see it anything less than that, $2 more, $3, $4. Right at expiration, if both options are in the money, it will be exactly $5 more, but no more than that. So let's say that we had the $100 call for 10 and the 105 call for 3. All right, well, we just said that the $100 call should be worth more money, and it is. However, there's another pricing principle that says the difference in these prices can't exceed the difference in the strikes. And notice what we have now. We have a $7 difference in the prices, but we have a $5 difference in the strikes. So even though the 105 call should be cheaper, and it is, it's actually, relatively speaking, too cheap. So now we have the 105 call trading here at 3 and the $100 call trading at 10. Well, it really should only have a maximum of a $5 difference, but it's a $7 difference. There's an extra $2 of benefit in the 105 call. See, now we see that the 105 strike actually breaks even sooner than the 100. So yes, you still have an advantage of paying 100 instead of 105 upon exercise, but notice in total you don't. It's going to cost you in total 110 to exercise the 100 call, and it's going to cost you 108 to exercise the 105 in total. So what's going to happen now? Arbitrageurs will recognize that, relatively speaking, the 105 call is the better deal. They will buy the 105 and sell the 100 for a net credit. So in this case, they would have a net credit of 7, but they've only got a $5 obligation. They have the right to pay 105, the obligation to sell for 100. That's a $5 loss. But they're getting paid $7 to do that. So that's like somebody asking you to take out a $10 bill out of your wallet and tear it up in exchange for a $20 bill. Well, of course you would. Yes, this trader has a $5 liability, but he's getting paid $7 to put it on. That's why it's an arbitrage. So now if they buy the 105 strike and sell the 100, they go into a bear spread. They're long the 105, they're short the 100, but notice they have a guaranteed gain of 2 and now an absolute maximum of 7 if the stock falls below 100. So again, what does it do? It forces traders to go out and buy the 105 and sell the 100. And what's going to happen now? Well, now the red line is going to start sinking towards the black, while at the same time, the black line is rising towards the red until what? Until we cross. So this is how we know for a fact that all strategies, no matter which ones you compare, will always have a crossover point. And what it shows, and this is super important, it shows that both strikes are equal given the current prices. So what you don't want to do as a trader is to look to try to find the best strategy or one that's better than another. What you're really doing is looking for pricing discrepancies relative to your outlook. And that's where you're going to find an edge. Because remember, if there's no apparent edge, there's no reason to trade, and crossover points show why. And so for anyone who'd like to learn more about the arts and science of options trading, please check out a brand new Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.